Hi, everyone. My name is Fawad Razaqzada. Welcome to today's webinar. So this webinar is meant to be very interactive. Please do ask me any questions you have on any tradable markets with Think Markets, and I'll be more than happy to respond, perhaps towards the end of the webinar. For those of you who are watching this live on YouTube or elsewhere, please consider joining us live for the next one, so that you could so that I could provide you analysis on the markets that you are interested in. Okay. But anyway, before we begin, please have a read through the disclaimer and risk warning, and I'm going to read the first paragraph with you. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So this webinar is meant to be all about charts and technical analysis, but we do touch on fundamentals. And speaking of the fundamentals, today's inflation data from the US is going to be very important. Okay, inflation is starting to build up as the US economy heats up. Now, the Fed chair, Jay Powell, said something very interesting yesterday, even though it, at first it didn't sound that interesting. It sounded quite normal thing to say for the Fed chair, that he said that it was highly unlikely there would be any rate increase or any rate hikes this year. That's the interesting part, okay? Because before the Fed was saying that it was unlikely there would be any rate hikes in a few years' time, within a few years' time, perhaps until 2023, 2024. But now he says it's unlikely there would be any rate hikes this year. So there's a subtle change in his tone, in the Fed chair's tone, suggesting that perhaps they are watching incoming data closely now, because things have improved a lot in the last few months, with the vaccination rates and data as well coming in stronger. We saw the employment report a couple of weeks ago, which was well ahead of expectations. So if we do see further improvement in data, this will raise a speculation that the Fed might have to tighten its belt sooner than it wants to, in order to prevent the economy from overheating. So for that reason, I think bond yields are going to rise further, extending their gains from the last 5 or 6 months we've seen. And the dollar has had a very good first quarter. The second quarter has started slightly weaker for the US currency, but the underlying trend is now, I think, bullish. So if you do see further improvement in data, starting with the USDJPY today, then that could send the dollar soaring higher. So watch out for that. But looking ahead for this week, we've got some more data from the US. I haven't written it here, but I think there's some data on Friday as well. Retail sales on Thursday, unemployment claims, important for the dollar as well. We have the quarterly earnings season kicking off as well tomorrow, with large US banks such as JP Morgan and Goldman Sachs reporting. And in between that, we have the RBNZ rate decision on Wednesday. So if you trade the New Zealand dollar, that's going to be very important for you. We have the Aussie employment report on Thursday, again, very important if you trade the Aussie dollar. Chinese GDP on Friday is going to be very important. So lots to look forward to this week from a so lots to look forward to from a macro point of view this week. And we will be writing reports and other form of analysis on these events. One thing I haven't mentioned here is the Coinbase IPO. So, we've seen cryptocurrencies rallying to new record highs in recent times. And today, I think both Bitcoin and Ethereum hit new highs ahead of the initial public offering of Coinbase. So the fact that cryptos are rising ahead of the Coinbase IPO, I think the price of this crypto exchange is going to be going up, because they make their money when people buy and sell things, right? Buy and sell cryptos. And with Ethereum and Bitcoin hitting new highs, volatility is going to increase further. Anyway, let's start by looking at the FX markets. We will cover the cryptos towards the end of the webinar, okay? And I'm going to start off with the dollar index. And this is the monthly chart of the dollar index. In the first quarter, as you can see, in January, Feb, March, the dollar rallied sharply. It came up to retest the backside of the long-term broken trend line. This is the trend line. And it bounced from there. It fell, okay, at the start of the second quarter, or at the start of April. I think the underlying trend is bullish. Last month, we had a nice big green or white candle in this case, taking us above resistance in this area. This level here at 91.75 to 92 should have offered some resistance. It didn't, and we went through it. So now the index is retesting that area, which means there's potential for the dollar index to bounce from here and head higher, as I've envisaged with this purple line. So we've already seen the retracement, but now can we see the dollar start to rise? Looking at the daily chart, you can see that area more clearly here. I've shaded it in green here. Previously, this area was resistance, turned into, sorry, it was support previously, turned into resistance. We broke above it, consolidated for a while, and then pushed higher. Now we've come back down to retest that area of consolidation, that demand zone, so to speak. And the dollar, as you can see, has started to respect that zone. And if you look at the shape of the last few candles, daily candles, the bodies have held above the zone, suggesting there's demand for the dollar around this area. So what I'm looking for next is, can the dollar break through this short-term bearish trend line? If it can, well, we have started to move above it today, but CPI data coming up later on, that could change the picture completely. If CPI comes in much stronger, then that should send the dollar higher. This is the level I'm looking at in terms of short-term pivotal level at 92.50. This black level here. This was resistance, support. It broke down, turned into resistance. So if we go back above it, that would indicate to me that the bullish trend has resumed. Okay, so that's what I want to see next for the dollar from a bullish point of view, before turning more bullish on the reserve currency. However, if it breaks through this support area, then that would complicate the picture a little bit. In that case, we could see the likes of the euro dollar, the pound dollar come back really strongly in the days ahead. And I wouldn't be surprised if the dollar were to go on to, I don't know, test 90 long-term support level around here before deciding on its next move. But ideally, from a macro point of view and from technical point of view, I don't want the dollar to go down too much. Otherwise, it will complicate the technical, the outlook, because everyone's expecting the US economy to rebound really strongly, and so the dollar should hold, you would think, right? And this is the area it needs to hold from a technical point of view. Let's see if that if it starts to build a base here and pushes on, and if it does push on, as I say, 92.50 is the key first key level. Break that, then we would be talking about the first quarter highs. around 93.40-ish, and then 94.65 is the next key level of potential resistance. But we'll cross that bridge when and if we get there. Okay, 94.65 was previously resistance and support and resistance. Okay. Dollar yen is going to be in focus today, obviously. So far, it has played out exactly how we had envisaged in our previous webinar, namely that it will break out of this consolidation pattern to the upside and go on to retest this zone at 110.75-ish. And then from there, we thought it will retreat because this was a supply area. And then now it's kind of returned back to the base of the breakout. So let's update this chart a little bit. So 109.30, call that 109.35 to 109.40, this area here. Okay, it's the key support to watch on the dollar yen because this area was the top of the previous resistance or consolidation range from which price broke out from. So now it's retesting this area. What you want to see is for price to hold here and push higher again. So a lot obviously depends on today's CPI data and the upcoming macroeconomic numbers from the US and elsewhere. If we do see strong data for the US economy, I think there's no reason why this dollar yen pair cannot push on further from here, especially given that the Bank of Japan is still quite dovish relative to the other major central banks. And the Fed is potentially going to turn more hawkish as more people get vaccinated in the US and as economic data start to improve with the easing of lockdowns. So I think over time, the dollar yen is going to rise. It's just a question of timing. But in terms of short term, I think 109.35 to 109.40 needs to hold for the bullish trend to remain intact. Obviously, any move below this red level here at 108.20, call that 108.30, a break below this area would be bearish short term because this was the base of the last consolidation before the breakout. So there's no reason for price to come all the way down to retest this level again if the trend is still bullish, right? So if price were to come down here, then at that point, I'll drop my bullish view on the dollar yen, at least in the short-term outlook. In which case, then the dollar yen could then start to descend towards the next level of support, which is at 106.15 area here. So if it breaks this level, 108.30, then at that point, things would start to look bearish for the dollar yen. For now, I'll have to give the benefit of the doubt to the bulls because the underlying trend is bullish. Price is at support, formerly resistance. It could easily bounce from there. So this is what I'm expecting. Euro dollar, same kind of similar picture. The euro has bounced in recent times, like all the other major currencies. The underlying trend is a little bit bearish for the euro because of the dollar's strength more than anything. But we've seen the eurozone having difficulty with getting the vaccinations program underway. There were delays, production delays, and etc. But now it looks like the eurozone has finally got its act together. Nonetheless, the eurozone economy is not as strong as the US economy in relative terms. And it looks like the European Central Bank will maintain its current monetary policy stance for a lot longer than the Fed is, meaning that there will be further pressure on the euro for months to come. So from that point of view, you'd have to think that the euro dollar is going to head lower over time, unless something fundamentally changes in the favor of the eurozone. I haven't seen that change yet, which means I expect the euro dollar to go down from around current levels. Now, the pivotal level is this shaded region in red here, between 119.50 to 120 area, previously resistance and support. If we get above that, then I will have to reconsider my bearish thoughts on the euro dollar, right? Because then price will have created a higher high above this area where the black arrow is pointing at. So any move above 120 would be bullish, which means I would have to drop my bearish views on this on the euro dollar, and indeed on many other currency pairs. But what I want to see from a bearish point of view is for price to break through this blue area, blue shaded region here, between 118.35 to 118.70. This area was formerly support. We have moved above it for now, testing the 200-day moving average. But if price comes back below this zone, I think that would take out the weaker longs that have been accumulated in this move up, leading to a possible drop to below this area where there's going to be lots of stops resting from people who bought the euro dollar. But there's going to be more stops resting below this double bottom low here at 116. And that's the next key area for me for the euro dollar to potentially head down to next, to take out that pool of liquidity. Remember, the markets are a function of liquidity. Price moves from one area of liquidity to the next. So that could well be the next target for the bears. But before we start talking about 116 or below 116, price will have to get through this support area that I have talked about. Okay. So we have covered the dollar index, dollar yen, euro dollar. Let's talk about some commodity currencies now. And if you have any questions, meanwhile, please write them in the chat box or in the questions and answers box, okay? And please keep your questions coming, because I like to talk about the markets that you guys are interested in, rather than me boring you with the markets that you are perhaps not interested in. So let's talk about Aussie dollar. The Aussie dollar is like most other currency pairs. It's been kind of stuck between a rock and a hard place over the last several days due to the lack of any major fundamental news. But that will change this week. We have USDJPY coming up shortly, and we have well, from Australia we have the that employment report, haven't we, on Thursday? So one way or another, the Aussie dollar is going to move from its current range. And judging by what happened to Chinese equities previously, I was expecting the Aussie dollar to break down. I'll show you what I meant. Yeah, this is the Chinese stock index, one of the Chinese stock index indices. As you can see, the market has broken down in recent times, starting from early February. Meanwhile, if you look at the S&P 500, this has been continuing to push higher. Yeah, and other US indices as well, they've continued to rise. Nasdaq. This is the Russell, etc. But Chinese equities have started to come down, and when something happens to China, usually it impacts the Australian dollar. Also, if I show you copper prices, you can see copper has stopped going up, although it hasn't broken down completely yet. Okay, when copper starts to, if it starts to fall, that's going to be bad news for the Aussie, because obviously Australia is an exporter of copper and other base metals such as iron ore. So commodity prices have, especially metal prices, have big implications for the Australian dollar. So based on those markets that I just showed you, I was expecting the Aussie dollar to fall quite sharply. It hasn't really worked out that way for now. We've got this head and shoulders pattern here. We've broken the neckline. This black level here was the neckline. But look what happened when price fell through it on this particular day. It didn't quite hold below the neckline, which is potentially a bullish sign. I say potentially because there's still a possibility that price can head lower due to the strength of the US dollar and the fact that there's been a very little upside follow through following the formation of that hammer-like candle. So when I saw this, I said, okay, this is looking bullish, and I'm going to drop my bearish view on the Aussie dollar. But looking at price action in the last few days, if this was a key reversal pattern, surely price should have rallied really strongly by now. It hasn't. So the lack of upside follow through makes me think that perhaps the path of least resistance is still to the downside. Is still to the downside for the Aussie dollar. And so yeah, I think that there is a good possibility that price could do what I had expected it to do following the break of the neckline and head to the 200-day moving average, which comes in at 74.15 in the coming days. The alternative to this is obviously if price breaks higher and above the resistance trend of this bearish channel. So if we take out the bearish channel to the upside and hold above it, then at that point, things will start to look bullish for the Aussie dollar once again. Make sense? Let's talk about the Canadian dollar. Canadian dollar tends to track oil prices closely. Oil prices have come off their highs in recent times. So the Canadian dollar has come off its highs, meaning the dollar CAD has bounced off the lows. This is the weekly chart. Price has broken the bearish trend line that was in place since the height of the pandemic in March 2020. So this is the first key sign of a potential reversal, with price forming support around the key psychologically important 125 handle. What we need to see next is for price to make a higher high before we turn decisively bullish on the dollar CAD. So let's zoom into the daily. Now on the daily chart, I think this should be here, right? This was the last high prior to price making its most recent lower low. Make sense? So price will have to get above that level in order to create a higher high at 127.50-ish or 127.45. Okay, that's what I'm looking for on the Canadian dollar. This level as well is important because it's the most recent high that was formed, but it's not the most significant higher high or lower high, sorry, that needs to be taken out. So it's possible, therefore, that we could break this lower black line, move above it, and then come back down. That's very much possible. But if we hold above it, then it would indicate that perhaps price wants to push on and take out that level of resistance at 127.50 next. So keep an eye on the dollar CAD. I think this pair could rise sharply in the coming days, possibly rise to 130, provided we get a break in market structure of lower lows and lower highs. So a break above 127.50 is what I'm looking for. Once we get that break, if we get it, then you can zoom into your lower time frames like the hourly or the 4-hour chart, and then you can start looking for trades on the long side. If you're bearish on this market, I think it needs to go below 125 now to kind of signal the resumption of the long-term bearish trend line, bearish trend, because the recent consolidation is potentially bullish. So you want to see that bullish price action becoming invalidated once again before looking for a continuation lower. So those are the two scenarios that I've just highlighted for you. So price is coming up to this area of resistance today. We have the USDJPY data coming up. Will it be able to break through this first area of resistance? If it does, that will be the first key bullish price action on this pair, or the second key bullish price action on this pair following the break of the trend line. The third and the most important will be, as I mentioned, the break of, or the potential break of 127.50. Let's move on to have a look at some other markets now, guys, because time is running out and I can't see any questions from you guys. Please do write any questions you have in the questions box or in the chat window, and I'll get back to you as soon as I can. Bond yields are going to be important today. This is the 10-year bond yield price, or the yield of the 10-year bonds. Recently came down to retest this support area, and so far it's holding, which is good news for the dollar, I suppose. If it breaks down, then that would be bad, I think. But the underlying trend for bond yields has been bullish, so I'm expecting a continuation higher from here. Let's look at some commodities now. Gold should be looking bearish, and indeed it is. I mentioned gold in my previous webinar. I don't know if you guys were there. Mentioned this resistance area between 1755 to 1765. And this area was previously support and resistance. I say that because of the strength of US dollar and rising yields, gold is likely to turn lower from there, and it has indeed turned lower. A lot depends on gold and on the dollar and on bond yields for gold to turn positive once again. Listen, there might be strong demand for gold in the physical form, but in the paper form, gold is dependent almost entirely on the direction of the US dollar and bond yields. Currently, both are going against gold. Bond yields are rising, which means the opportunity cost of holding an asset that pays no interest or dividends is rising. Why would you hold something that costs money to store and doesn't pay interest or yields when you can invest your money in the bond markets, is the question yield-seeking investors are asking themselves. So that's the reason why gold is struggling at the moment, because yields are rising. People are able to get better return on their money invested elsewhere. Obviously, we're not talking about capital appreciation, just talking about yields, okay, a safe return. The dollar, the dollar as well, you know, it's bouncing back today, and it could start another rally if the consumer price index comes in stronger. So those are the reasons really why gold is struggling, and I can't see that change in the near term, to be honest, because you know, we talked a lot about what's happening in the economy, the vaccinations race. It looks like lockdowns will soon end, and there's going to be strong recovery in the US and elsewhere, which is why equity markets in the US have rallied to new record highs. Bitcoin is surging. So I'm not really too keen on gold, you know, at the moment. Not until it breaks through the resistance area I mentioned between 1755 to 1765. If it breaks through that area, then maybe in the short term, it's going to start to look a little bit more positive. But for now, I'm not really too keen on gold from a bullish point of view. Crude oil is, well, not doing a lot. It has been stuck in a very narrow consolidation range. Investors are kind of in two minds at the moment. First, there are signs that demand is improving because lockdowns are starting to end in it. Well, certainly in the UK, lockdowns have started to ease. But with the vaccinations program going quite well in the US, and it looks like the Eurozone has finally got its act together as well. As we head to the summer months, you know, demand for crude and crude products should start to rise. And so demand is there, it's going to improve, but what about supply? That's the key concern for crude oil at the moment. Right now, the OPEC and its allies, known as the OPEC Plus, are still keeping supply restricted, but they have started to ease those restrictions. And the concern is that if oil comes back, it's released back to the market as more restrictions ease, supply of crude oil is going to rise rapidly once again because oil prices have risen. It makes it profitable for oil producers to produce more oil at these levels than at lower levels because they can make more profit from it. So if supply comes back, that should put downward pressure on oil. And don't forget about US shale producers. They could come back in a meaningful way as well. So it's kind of oil is kind of stuck in a balance at the moment as investors weigh demand and supply outlooks. Soon the direction will become clearer. So when it breaks decisively from this consolidation range, either to the upside or to the downside, we should have a very good idea in terms of where price could get to next. As a minimum, if it breaks to the downside, I would expect 53.50 for WTI. That was the last area of resistance, never been retested once we broke above it. While a break to the upside could target 63.60 first, the base of the previous breakdown, ahead of 65 and possibly even 70 over time. So watch crude oil prices closely, guys, because it's consolidating for now, but when it breaks from the consolidation, it's going to move really sharply. Now then, cryptocurrencies. Bitcoin hit a new record high today. This comes ahead of the IPO of Coinbase, which is a major cryptocurrency exchange in the US. The IPO is happening on Wednesday. This is important for the cryptocurrencies because, when a crypto exchange is going public, it kind of lends more kind of official credence to the sector. So there's going to be more credibility for cryptos. We've seen lots of major companies start to accept Bitcoin as a form of payment. And this is just the ongoing story, really, that more and more companies are accepting Bitcoin. There's mainstream acceptance. And now a major Bitcoin exchange is going public. So because of that demand, cryptos are still finding good support even at these levels. And with the case of Bitcoin, we all know that the supply of the thing is limited and there's so much demand for it. So it kind of makes sense for Bitcoin to continue making these higher highs and higher lows. But eventually the run will end because people will take profit at some point. Until we see that reversal, I would continue to play Bitcoin and other cryptos on the long side. So looking at the chart of Bitcoin now, the key support area is now between 60,000 to 61,200, this blue level here. Because this area was formerly resistance. So that's going to be the first area of support. And the key low to look out for is this one here at 55,400, this low here. This was the last low made prior to price breaking out to a new record high. So if Bitcoin were to come back down and take out this low, then at that point, the short-term bullish structure will change. So that would be a reversal sign if Bitcoin were to break below this level, at least in the short term anyway. That could then pave the way for a retest of the 50,000 level, where we have the long-term bullish trend line coming into play. Keep an eye on Ethereum as well, guys. Ethereum is looking really strong, continues to break out of consolidation patterns. You can draw your fibs to get some objective targets on the upside. So the 127.2 extension of the last downswing comes in at 2,400, just above that. The 161.8 extension comes in at 2,866, and so on. So yeah, cryptos are looking strong at the moment, and I can't really say anything from a bearish point of view because the trend is bullish. But what I can do is prepare you for a potential breakdown. So, for example, this trend line, if it breaks, that could be a short-term bearish development that could then pave the way for a correction of some sort. So if you do trade cryptos, always be prepared for a sudden drop, because they do drop sharply when they do drop. For example, here. Yeah, and keep raising those stops to lock in profit if you are trading it. Obviously, if you're investing in cryptos, that's a completely different story. If you're a long-term buy and hold investor type. But if you're trading it, like any other markets, you have to be very careful with your risk management. So keep raising your stops to levels where if price breaches that level, it no longer makes sense for you to hold the crypto. Let's go and talk about indices now very briefly, because we have run out of time and I can't see any questions from you guys. So I will make the indices the last thing that we're going to talk about. Now, this is S&P 500. This 161.8% extension that you can see on the chart is derived from the that big drop that we saw when the pandemic hit in February 2020 to the latter parts of March 2020. That sharp drop that looked really scary, didn't it? At one point. Well, look what happened since then. The index created a low here, thanks to the efforts of major central banks and governments worldwide, providing lots of liquidity for the markets. They pushed down interest rates to below zero in some cases, and more QE was introduced. So the flood of freshly created new money came into the financial markets, drove equity prices to new record highs, even at times like now. And now the key question is this: as we move towards the normalization process of the major economies, as central banks start to unwind their emergency measures and reduce QE, and central banks would, and governments would draw support from a fiscal point of view, are we going to see the reverse of what we saw since March 2020? Are we going to get a stock market correction, is what I'm trying to get at. I think it's very likely, in my view, that we will see a sharp correction of some sort soon, because the run-up has all been about liquidity and cheap central bank money. With the world economy recovering and inflationary pressures building, the Fed and other central banks are going to tighten their belts soon. Yeah, because they can't allow inflation to be overcooked. So in the coming months, I think what we will see is at least a slowdown in the rally, like a consolidation. But when we see evidence of central banks actually reducing their asset purchases, at that point, then we could see the markets come down. Or another scenario would be investors might be expecting that ahead of time, which is something that they normally do. And we could see that reversal happening quite soon. So as the equity markets test new record highs, keep an eye on the major indices, because if they do turn, it's going to be quite important. Even if you don't trade indices or stocks, it's going to have implications for the wider financial markets. Right. I'm going to wrap it up there, guys. I can't see any questions. Thank you so much for joining me. For those of you who have watched this on YouTube, if you want to join us for the next session, it's very easy. Go to the website, thinkmarkets.com, market analysis, and click on live webinars. Here you will see a schedule of our upcoming webinars, and you can basically just click on register button for the next one, put in your details, and then you'll get an email reminding you when the webinar is going to take place. Okay, guys, I'll speak to you next Tuesday. Thank you so much for staying with me so far, and I wish you a wonderful week ahead. Be careful out there. Take care. Bye-bye.